Welcome back to The Breakdown with me, NLW. It's a daily podcast on macro, Bitcoin, and the big picture power shifts remaking our world. What's going on, guys? It is Thursday, May 15th, and today we are talking about an IPO that actually went well. Before we get into that, however, if you are enjoying The Breakdown, please go subscribe to it, give it a rating, give it a review, or if you want to dive deeper into the conversation, come join us on the Breakers Discord. You can find a link in the show notes or go to bit.ly/breakdownpod. Well, friends, eToro's monster NASDAQ debut suggests that the IPO window may be wide open. Fintech trading platform eToro saw a huge pop on their public listing yesterday, with the stock rising 29%. The listing was already hot heading into the IPO, with the company upsizing the number of shares on offer. Initial pricing also went well above Wall Street forecasts, making the first day pop even more noteworthy. The company now has a public valuation of $5.4 billion, so it's still a relative minnow compared to its rival Robinhood that's currently priced at $54 billion. It might be going too far to call eToro a crypto IPO, although the trading platform is increasingly focused on crypto. They offer 130 crypto assets, but see very little volume on most trading pairs. eToro generated $12.1 billion in revenue from digital assets last year, which was up 4x from the previous year. That dwarfs their $330 million in revenue from equities, commodities, and currencies, largely due to a 1% fee on both buying and selling crypto, set against free trading for stocks. The platform recorded over $11.8 billion in costs to generate that crypto revenue, so that doesn't make them extraordinarily profitable. Still, eToro's balance sheet looks very concentrated on the crypto business, with everything else being relatively negligible. And because of that, the point is that eToro has verified market demand for new public crypto companies. The platform shared the rocky road to a public listing that many companies have faced over the past few years. They first attempted to go public via SPAC, but couldn't get the deal out the door before market conditions turned. The deal would have valued the company at $10.4 billion, so based on where they are now, eToro did leave some money on the table by missing the window. eToro got caught up in Gensler's dragnet in 2023 and suspended trading for 24 crypto tokens named in SEC lawsuits. The company then filed for a traditional IPO this March, right into the jaws of the Liberation Day market collapse. But the stock is now trading on the NASDAQ, and its performance seems like a green light for other crypto companies to list. There's half a dozen crypto firms looking to go public over the coming year, and right now appears to be one of their best opportunities. We have Galaxy Digital uplisting from the Toronto Stock Exchange on Friday, so that box is already checked. Circle followed a similar path to eToro with a failed SPAC and preparations recommencing in earnest in late 2024. They've said they're targeting the first half of this year and are only awaiting a sign-off from the SEC, so that listing could be any week now. A new entrant is Animoca Brands, whose CEO Yat Su told the Financial Times earlier this week that this is a unique moment to enter the world's largest capital market. Su said that a year ago the investment firm wouldn't have been considering a US listing, but it's now a, quote, very important part of the roadmap. He added, "If the US didn't do what they did with regulators under Biden, we probably would have competitors in the US. Normally we'd be fighting with some giant or something. It's the biggest market, so we should go there, right?" Su later walked back the comment slightly, calling them a misunderstanding and stating, "I was referring to ramping up our overall activity in the US, primarily products and service offerings. I was not explicitly stating that we will list in the US or in New York, although that's certainly a possibility." Potentially the biggest crypto IPO will be Kraken. The exchange hasn't seen a public valuation since 2021, when they raised funds at $10.8 billion. But the company's Q1 earnings showed 19% year-on-year revenue growth, with $187 million in EBITDA profits for the quarter. That's around 1/5 of Coinbase's profits, and only slightly behind the US leader's 24% year-on-year growth. Kraken has been making a lot of moves to prepare for IPO, with a recent leadership shakeup and a big acquisition alongside cost-cutting layoffs as well. All reports suggest they're targeting next year, but eToro's success might encourage them to strike while the iron is hot. Generally, this is a signal that US capital markets appear hungry for new entrants. Katie Roof of Bloomberg tweeted, "eToro IPO priced above the range, increased the size of IPO due to demand, and then we popped. Are we back?" Zach Townsend, the CEO of Meanwhile, a Bitcoin life insurance company, said, "Hard not to be bullish on fintech when eToro raised $620 million in an upsized IPO, and Chime follows their S1 on the same day." Dan Tapiero noted that this is the first public exit for his crypto equity-focused fund, 10T, no doubt helping investors recommit to the thesis. And as someone who has been watching this up close and personal, the lack of IPO liquidity has been a major detriment to LPs, so that has got to be an exciting one. We'll see what comes next, but for now, a crypto-focused trading platform is the biggest news on Wall Street. It continues to be the case that the biggest theme for right now, outside of the testy politics of Washington, is the blending of TradFi and crypto. Tokenization infrastructure continues to be a big theme within that, with JPMorgan testing new capabilities with Chainlink and Ondo Finance. The bank has completed a test transaction that settled the transfer of tokenized US Treasuries between public and private blockchains. That should come as no surprise, with JPMorgan's Kinexys network essentially just a permissioned Ethereum fork, allowing for good compatibility with crypto tooling. Still, the proof of concept is an important one. Assets were transferred from Ondo Chain to Kinexys, which, by the way, if that's not how they pronounce it, boy, whoever you have in charge of naming should be fired, because there are simply too many consonants next to each other. Anyway, the transfer happened with near instantaneous payment flowing in the other direction, an arrangement that's referred to as delivery versus payment, or DVP. Settling transactions in less than a day is basically impossible for TradFi rails, so the use case is extremely enticing for legacy financial firms. In a press statement, the companies wrote, DVP transactions are difficult to execute in traditional finance due to fragmented systems and manual workflows, leading to costly settlement delays and increased counterparty risk. In just the past decade, it is estimated that payment and settlement failures have cost market participants at least $914 billion. DVP issues are further compounded in cross-border transactions by complex regulatory, geographical, and currency limitations. Chainlink CEO Sergey Nazarov said, "It is becoming increasingly clear to the world's institutions that they have a large addressable market in the public chain community and that they need a reliable set of technical standards and cross-chain connection capabilities to successfully transact in this new world." Another interesting signal coming from TradFi is executives jumping ship to crypto-native firms. We saw a reasonable amount of this kind of activity during the last crypto winter, as TradFi shut down their crypto pilots, and that was clearly about people with conviction looking to keep building in crypto. Now, with TradFi racing to adopt crypto, it sends a different signal about the speed to market at legacy financial firms. This week's news was Morgan Stanley's head of digital asset markets, Andrew Peel, taking leave to launch a new tokenization firm out of Switzerland. Peel had been driving crypto adoption at Morgan Stanley since 2018, and in a LinkedIn post he wrote, "Despite the volatility, I've always had strong conviction that Bitcoin and other quality crypto assets would become relevant for traditional finance. The success of the spot Bitcoin ETFs and the US regulatory shift has more than validated that belief." The block followed up with Peel stating in a message that, quote, "As RWAs move on-chain, TradFi will follow. Building the infrastructure and products to move them there is how we realize the future of on-chain finance. Traditional finance capital will seek the returns of DeFi opportunities. TradFi institutions will increasingly leverage and interact with DeFi technology. Regulation and technology will evolve to support the shift." We don't know any further details about why Peel is stepping away from Morgan Stanley or exactly which part of the stack his new startup will target. But on face value, this sort of seems like a signal that TradFi is not building fast enough to capture the full benefit of the pivot to crypto rails. Keeping on this theme, crypto prime broker Falcon X has partnered with global bank Standard Chartered to scale their institutional services. Falcon X said in a statement that, quote, "Standard Chartered will provide a comprehensive suite of banking services to Falcon X globally, further strengthening the platform's offering for institutional clients. Initially, the partnership will see Falcon X integrate Standard Chartered's banking infrastructure and improve cross-border settlement for global clients. They also plan to expand their offering to a larger group of entities, including asset managers, hedge funds, token issuers, and payment platforms. The expansion is set to begin in Singapore, with ambitions to later spread across Asia and into the US and Middle East. Standard Chartered, meanwhile, has been ramping up their crypto business significantly this year. In April, they inked a deal with OKX to hold crypto and tokenized fund collateral off-platform for institutional investors. As well as gaining access to global banking rails, this partnership could help Falcon X access more capital to lend to their institutional clients. We discussed in a recent show how crypto funds have been struggling through a credit drought since 2023, and this deal could be a way to ease access to capital. Beyond anything else, it's a gigantic global bank hooking themselves into crypto rails. Crypto copywriter Vincent PCO wrote, "Standard Chartered sees the crypto market hitting $10 trillion by 2026, and they're acting on it. TradFi and crypto integration accelerating." Lastly today, an update on 21 Capital. Corporate Bitcoin accumulation continues to be one of the big stories of the year, and one of the initiatives announced recently was 21 Capital, a joint venture between Tether, SoftBank, and Cantor Fitzgerald, with Strike CEO Jack Mallers at the helm. They're still awaiting a public listing via SPAC with no clear timeline on when the stock will begin trading, but Tether is not waiting around, contributing another $450 million worth of Bitcoin to the vehicle last week. According to new disclosures, Tether bought over 4,800 BTC at $95,000 each last Friday. 21 Capital already has over 36,000 Bitcoin in their treasury, worth roughly $3.7 billion. That means they'll enter the markets as the third largest Bitcoin treasury company behind MicroStrategy and Marathon. Mallers has said the goal is to accumulate as much Bitcoin as possible, and they're well on their way. The JV intends to launch with 42,000 Bitcoin already secured, so they've still got another $600 million to buy between now and whenever they get the green light. From there, the plan is to run the Saylor playbook, issuing convertible debt to fund more Bitcoin purchases. The JV is also well positioned to experiment with other Bitcoin-focused financial instruments through Cantor Fitzgerald's investment banking arm. Now, there are still a wide range of opinions on this growing trend. Investor Chris Millis wrote, The craziest thing about the flood of all these new Bitcoin treasury companies entering the market is that literally 99% of the world has zero idea what is happening, and yet it's the biggest thing to happen in finance ever. Marty Bent of 1031 Capital believes there's a better way, writing, "Highly profitable operating businesses that roll profits into Bitcoin is way more exciting than pure-play Bitcoin treasury companies. There's never been a better time to start a business that finds product market fit and cash flows quickly with 2 to 3 people. Bitcoin plus AI will be the most powerful combined force of this decade. If you're not leveraging both in your business, you're making a big mistake." Meanwhile, there are plenty that are starting to get the cold sweats over Bitcoin treasury companies, with Bitcoin Isaiah tweeting, "I'm just glad we finally know what this cycle's bubble will be. 2017 was ICOs, 2021 was NFTs, 2025 is Bitcoin treasury companies." Scott Melker is thinking the same thing, writing, "I hate to even think this because I'm a huge fan, but Bitcoin treasury companies raising debt to buy Bitcoin could be the next bubble." And Peter Schiff couldn't help himself, tweeting, "The only thing more ridiculous than buying Bitcoin is buying shares of a Bitcoin treasury company whose sole business purpose is to acquire Bitcoin. If you want to buy Bitcoin, then buy Bitcoin. If you want to invest in the stock market, buy a company with an actual business." Bold words from someone who runs a fund whose sole purpose is to hold gold. For now, though, that is going to do it for today's breakdown. Appreciate you listening as always, and until next time, be safe and take care of each other. Peace.